Every single great business, I mean from your local coffee shop all the way up to a global tech giant, eventually faces the exact same huge question. When it's time to grow, where does the money come from? So today, let's map out the financial landscape every founder has to navigate. Okay, so picture this. Your idea is finally working. You've got customers, you've got momentum, and you see this massive opportunity to expand. But that takes cash, right? Cash for new equipment, more staff, maybe a bigger office. So what's your first move? This isn't just some abstract question. It's the fundamental crossroads for every single growing company. That very first decision you face really just boils down to one simple question. Do you look for the money inside your own company, or do you go out and ask someone else for it? This is the big split between internal and external finance. Let's break that down real quick. Internal finance is all the money you generate yourself, without needing an outsider's approval. Think of it as using what you've already got in the building. External finance is the total opposite. That's when you bring in cash from outside sources, which, and this is key, always requires getting someone else to say yes. First up, let's explore that internal route. This is often called bootstrapping, literally pulling the company up by its own financial bootstraps. So how do you actually do that? Where does this internal money come from? Well, internal cash really comes from two main buckets. For the long term, the big one is retained profits. That's the money your business earns and then decides to reinvest right back into itself. But in the short term, you can also generate cash just by being smarter with your operations. Collecting money from your customers faster, holding less inventory on the shelves, or even strategically delaying payments to your own suppliers. So the really crucial point here is that bootstrapping has some pretty clear trade-offs. The upside? It's huge, it's fast, you don't give away any ownership of your company, and you avoid nosy investors looking over your shoulder. But the downside is just as real. There's only so much cash you can squeeze out internally. And you've got to be careful. If you push your suppliers too hard by paying late, you could seriously damage some really crucial relationships. Eventually, most growing businesses, they hit the limits of internal funding. When your ambitions are just way bigger than your bank account, it's time to start looking outside for capital. And let me tell you, the world of external finance is vast. At first glance, it can look pretty complicated, right? You've got short-term options like bank overdrafts all the way to long-term sources like finance leases or even issuing brand new shares in your company. But here's the secret. Almost all of those choices, all that complexity can be simplified into one powerful question. Are you looking for a lender who you'll just have to pay back? Or are you looking for a partner who will own a piece of your business right alongside you? This choice, this lender versus partner decision, is better known in the financial world as the choice between debt and equity. And I'm telling you, it is the single most important financing decision you will ever make. Let's make this super, super clear. Think of it this way. Debt is like a mortgage on your house. The bank lends you money. And yeah, you have to pay it back with interest, but they don't own your living room. Equity, on the other hand, is like selling a room in your house to a co-owner. They give you cash up front, but now they own a piece of the property, sharing in both the risks and, hopefully, the rewards. So, debt, in its most common form, is a pretty straightforward borrowing arrangement. You get a loan, it has a clear interest rate, and a repayment schedule. Now, in exchange, the lender often asks for security, which just means they can claim company assets if you fail to pay them back. They are a lender, not an owner. Simple as that. Equity, on the other hand, is usually raised by issuing what are called ordinary shares. And each share represents a tiny slice of ownership in the company. This gives the shareholder voting rights on big decisions and a claim on any future profits. They're now your partners, sharing the journey with you, for better or for worse. And hey, just to make things interesting, there's also a hybrid called preference shares. You can think of them as being kind of stuck in the middle. They get paid a fixed dividend, which is a bit like interest on a loan, but they don't usually get to vote like the ordinary shareholders. They really offer this middle ground of risk and reward. Now, if you look at this from an investor's perspective, it all comes down to risk and return. Simple borrowing? That's the lowest risk for them. They have a legal right to get paid back, so it offers the lowest potential return. Ordinary shares? That's the highest risk. If the company fails, the shareholder gets nothing. So because they take on all that risk, they demand the highest potential return. And those preference shares? Yep, they sit right in between. So we have our main types of funding, debt and equity. But it's not an either-or choice. The real art, the real magic, is figuring out the right mix. This is the big balancing act that every business leader has to perform.
Now, you might be thinking, well, since debt is cheaper and I don't have to give up any ownership, I should just take on as much as I possibly can, right? But is loading up the company with debt always the best move for the owners?
And this is where it gets really fascinating. What you're looking at here is the trade-off theory in action. Initially, as a company takes on some debt, its overall cost of money, what financiers call the weighted average cost of capital, or WACC, it actually goes down. And that's because debt is often cheaper than equity. But, and this is a big but, there's a tipping point. If you take on too much debt, everyone gets nervous. They start to worry about bankruptcy risk. Lenders demand higher rates, shareholders demand higher returns, and suddenly that overall cost of capital starts to climb right back up again. So the crucial point is this. Managing this mix of debt and equity, a ratio we call gearing, isn't about choosing one over the other. It's about finding that sweet spot. Getting this balance right means your money costs you less, which allows you to grow faster and more profitably, and that maximizes the value of the business for everyone involved. All right, let's just quickly recap the journey. First, you start by looking inside the business. When that's not enough, you look outside and you face that huge choice: lenders or partners, debt or equity. And that decision forces this constant trade-off between risk, reward, and how much control you keep. Ultimately, the goal is always to find that perfect blend of financing to power your company's future. So, let's go right back to where we started. You've got that brilliant, world-changing idea in your head, and it's ready to take off. After everything we've just talked about, what's your first move going to be? Where would you get the money?